Good morning, everyone. It's Tuesday, April 14th. Let's jump right into the dashboard.
We're seeing Bitcoin pushing higher, trading pretty firmly now between $74,000 and $75,000.
And at the same time, oil is dropping down to $88 a barrel. That's really going to help ease some of that inflation pressure.
The dollar index is weak. Simple as that. It's sitting at 98, and that's a huge sign that liquidity is improving.
And importantly, the 10-year yield, it's holding steady at 4.25%.
Okay, so let's be absolutely clear here. When you see a weak dollar, stable yields, and falling oil all at once, this is the cleanest risk-on signal we have seen in weeks. This is a definitive risk-on macro setup.
All right, so let's define the regime for today. We are calling this a liquidity-driven risk expansion.
So why this regime? Well, the main drivers are those falling oil prices we mentioned, plus some softer than expected inflation data. Both of those are easing the big picture macro pressure. And the crucial point here is that markets are responding directly to these much improved liquidity conditions. So what really kicked this all off? What was the catalyst? It all came down to this morning's Producer Price Index, the PPI report. Looking at the numbers, month over month came in at just 0.5%. That's well below the 1.1% forecast, right? And the core PPI year over year was 3.8% versus an expected 4.1%. That's a really significant miss to the downside. This is just a clear-cut downside surprise. It tells us producer-level inflation is cooling off way faster than anyone anticipated. And why does this matter? Well, it reduces that upstream pricing pressure, which is what eventually feeds right into future consumer inflation. And the market's reaction to all this, it's been textbook, really. We're seeing a broad rally across pretty much every asset class. So what does that look like? Bitcoin is breaking higher. Equities are pushing new highs. Volatility is getting crushed. And this is all happening while yields are stabilizing right around that 4.25% level, and the DXY stays weak down at 98. It's all connected. Taking a quick look at the levels. WTI crude down about 4% to $88. The S&P 500 is at 69.61, really pushing those highs. Gold also remains strong at 48.40, and Bitcoin, sitting right there between 74 and 75K, is arguably leading this entire move higher. And this illustrates a critical point. When you see equities, gold, and Bitcoin all rising in unison like this, that's a powerful signal. It's telling you there's broad, abundant liquidity. This isn't just money moving from one sector to another. This is new capital flowing into all risk assets. Okay, so let's trace exactly how this is all happening. The macro chain of events today is incredibly clean and logical. It all starts with that PPI report coming in soft, which immediately eases inflation pressure. That leads to lower inflation expectations, which then allows bond yields to stabilize. And that perfect combo, stable yields and a weak dollar, improves global liquidity conditions, which leads to the final step. That improved liquidity is what's fueling this powerful rally we're seeing in both equities and crypto. So, with that framework established, let's look forward. What are the potential scenarios for the next 24 to 72 hours? Our first scenario is the green light risk-on expansion. For this to happen, we need to see oil stay below 90, the dollar index stay below 99, and yields at or below 4.3%. And if those conditions hold, we'd expect the S&P to start targeting 7,000 plus, with Bitcoin pushing towards that $76,000 to $78,000 range. The logic is simple. Cooling inflation improves liquidity, and that momentum just keeps building. Okay, our base case is scenario 2, which is just consolidation. This is where oil trades in a range, say between 88 and 92, with yields in a tight band. In this case, you likely see the S&P just hover between 6,900 and 7,000, while Bitcoin trades sideways between 73 and 76K. It just means the market is taking a breath, pausing to digest the recent gains. And finally, the red flag scenario, a reversal. A bounce in the dollar index back above 99 or a spike in yields over 4.4% would be the trigger here. If that happens, it would likely push the S&P down towards 6,800 and send Bitcoin back into that $71,000 to $73,000 range. And the driver, a sudden tightening of liquidity, causing a short-term reset. So, if you remember one thing from today, let it be this. What we are witnessing right now is a classic liquidity-driven rally. To sum it all up, today's PPI data confirms that inflation is in fact cooling at the margin, and the combination of falling oil, a weak dollar, and stable yields is creating a really supportive macro backdrop for risk, Put it all together, and this combination is fueling a broad, powerful, liquidity-driven rally across the board.
We are now entering a window where liquidity is clearly doing the heavy lifting, which leaves us with a big question for the days ahead. Will markets continue to chase this upward momentum, or will they pause here to consolidate? That's what we'll be watching.